Hello friends, today we will be talking about a very important aspect. I think there is a lot of curiosity among the observers and more so the students and the banking professionals as to why the rupee is depreciating so steeply now, maybe due to the West Asia crisis and the supply side disruptions of the crude prices rising and many of the trade blockades that are happening now. So let's try to deep dive into the various dynamics which brings down the rupee value versus the dollar. So the steep depreciation of the rupee is a matter of concern for most of us. A common reason for a currency to depreciate is when demand for the underlying foreign currency, the US dollar, exceeds its supply. So, when the demand exceeds the supply, there is always a correction in the prices and it will be the depreciation. The greater the supply shortage, logically, the steeper the depreciation. Hence, demand supply dynamics of the US dollar determines the exchange rate volatility. The West Asia crisis elevated crude oil prices and caused supply side constraints, intensifying the depreciation of the INR. The rupee fell from 85.53 per dollar at the end of FY25 to a record low of 97.15 on May 19, 2026, recording a depreciation of approximately 13.6% in just 14 months. When we look at the past data, there has been a depreciating track of INR, but it was not that steep. It was 3.1% in FY22, 8.4% in March 2023, 1.5% in March 24, 2.6% in March 25. So it has been a steady depreciating trend because India is intrinsically an import dependent country with imports exceeding exports. So as a result, our trade is always in the deficit and we will have to make arrangements to see that we are able to honor the international commitments, use of different options that are available. The ongoing West Asia conflict, which began on March 28, 2026, sent Brent crude prices up from around $80, whereas we were also buying from Russia at a much cheaper price as far as the crude is concerned, and it has gone up to 100 per dollar within days, instantly worsening India's import bill and triggering dollar demand at an unprecedented scale. The partial closure of the Strait of Hormuz in Iran disrupted approximately 30% of India's crude oil supply routes, adding supply uncertainty to already elevated crude prices. Now, why INR depreciates? Let's look at some of the aspects. First, most important aspect is the dependency on global crude prices. India imports 88.5% of its crude, the highest import dependency in its history. Every $10 hike in crude costs India an additional 12 to 14 billion annually in dollar outflow. During FY26, petroleum import bill was 174.9 billion. The FY27 import bill is projected to peak somewhere around 240 billion if crude prices remain around 100 per barrel for an extended period and if the West Asia crisis lingers on for more prolonged period. As a result, India's current account deficit is widening from 0.8% of GDP in FY26. It is expected to go up to 2.5 to 3% of GDP in FY27 if the structural downward pressure on the rupee continues. First is crude oil prices. Second is outflow of foreign portfolio investors. Foreign portfolio investors, FPIs, have withdrawn around 17 to 18 billion from Indian equities in 2026, with each exit requiring conversion of rupees to dollars, putting pressure on the INR. Global risk aversion following the West Asia conflict triggered an emerging market sell-off in which India, with its large liquid accessible capital market faced disproportionately large outflows. India's deep, open capital account, larger than those of any South Asian peer, amplified the impact of outflows on the rupee. The third point is interest rate differential between India and Western world. RBI has cut the repo rate by 125 basis points cumulatively after between February and December 2025 from 6.5% to 5.25%, whereas the US Federal Reserve held rates at 4.25 to 4.5, narrowing the US-India interest rate differential from 200 basis points to near zero difference. The next fourth point is the US tariff headwind on export earnings. US tariffs of 26% to 50% on various accounts on Indian exports, the highest of any major trading partner, reduced dollar inflows from merchandise exports, gems and jewelry, textile, auto components, and electronics. India's major export categories all faced elevated tariff walls, reducing dollar earnings. Absence of a finalized US-India trade deal has sustained export uncertainty as well. Forex reserves fell by about 30 billion in just 3 weeks after the West Asia crisis erupted, and the reserves have come down from 728 billion to 698 billion now. So RBI intervention continued, selling dollars to prevent disorderly depreciation, and it provided temporary support to maintain the rupee value, but permanently depletes the reserve buffer available for future defense of the currency. While inward remittances from NRIs are expected to be marginally down from US dollar 140 billion in FY26 to about 137 billion in FY27, the external commercial borrowings are down by about 30% due to higher interest rates abroad and higher hedging costs. The import cover declined from 11 months to approximately 10 months now. Another aspect is the gold imports. India imported 72 billion worth of gold in FY26, second only to China globally, adding a massive second structural dollar drain with no productive return. Overseas travel spending at 31.7 billion in FY24, and it is growing. Remittances outward to families abroad and additional non-oil dollar demands. That is the reason why our Honorable Prime Minister has appealed to the people to avoid gold purchase and overseas travel, and acknowledged these non-dollar drain as significant contributors to rupee pressure. Other aspect is structural inflation disadvantage. India's average inflation is 5% to 6% because our WPI wholesale price index has crossed about 8.3%. And our CPI index is also rising now. So whereas the global peers have 2 to 3% inflation, this also puts the Indian rupee under attack. The CPI inflation is rising from 3.21 in February to 3.48. But one comfort is there that it is still within the midpoint of the glide path of inflation, which is maintained by glide path of inflation set for RBI monitoring of inflation. So, if we take all these aspects in a comprehensive way, we can say that the rupee pressure will continue. That is, the rupee will continue to be on the depreciation track unless we are in a position to improve our export capability on one side and try to conserve the foreign exchange as far as possible, improve exports for the purpose of, we should try to improve the exports, and the imports also should be restricted only for the purpose of exports. That is, import some components, value adding to them, and see that the exports go out and we get dollar earnings. So unless our dollar earnings are strengthened, and our NRIs, they plow back their savings into Indian financial system, and more FCNRI deposits have to come into India so to balance these. And among all these factors, the most important is export capability. We must improve export capability using Make in India, using SEZ, that is a special export processing zones. And India, we have also introduced in the GIFT City the Financial Services Authority, which monitors and which helps Indian entrepreneurs to do business with the rest of the world. IFSCA, that's what we call International Financial Services Center Authority, which is in Gift City in Gujarat. It is helping the Indian entrepreneurs to do and extend business with the rest of the world. So unless our export earnings go up, there is no way in which we can check the depreciation of the rupee. And we must, all of us collectively have to save on the energy, conserve foreign exchange, work towards educating MSMEs to improve their export capabilities, and create an ecosystem whereby our exports by design are able to increase to a level that can offset the import commitments that we have. And also the dependency on crude also has to be brought down by using alternate sources of energy, exploring solar energy, exploring the battery driven vehicles and transportation, and many things we will have to do that will also help us in reducing the mitigation of the climate risk, and it will also help us to see that depreciating INR can be checked to a large extent. So we will be discussing more about these aspects in the coming times. Till then, thank you very much for watching. Please subscribe to this channel if you haven't done so far, and share these pieces of videos with your friends for disseminating knowledge. And we will discuss more about the developments in the coming times. Thank you very much.